So let me introduce myself now. I am Shreya Cherian. I'm the operations director, and I would like to conclude what my lovely colleagues has explained here. So they've explained how it started, so they've explained the entire scenario of how it started and how it started with the collapse of SVB and consequent banks and all of that. So after that, we have also spoken about the global impact as well as the impact on emerging economies. So and we've also discussed the hot topic of debt ceiling and how it has been passed through the Congress, right? So now I'm here to dedicatedly explain the trigger points. So for us, all of us, after this discussion, we believe that the subsequent and the consequent interest rate hikes, which happened over 10 times over the past 14 months, triggering the interest rate in the US to be about 5.1%, which is the highest in about 16 years. So this would be the cause that we are seeing as the cause behind the collapse of the bank. So I'm here to discuss whether this is the actual reason for the collapse or whether there are other fault lines that has triggered this. So through my research, I was able to find that the Fed began increasing rates a year ago. Why? To combat the inflation. And inflation began as a result of a lot of cash being circulated in the economy and the high prices that came up with the supply chain disruptions during the COVID and the war. That, as my colleague Adashi has discussed, the consequences of war and COVID on the economy that led to widespread inflation not only in the US and but also in other parts of the world. So the central bank has a powerful tool to control the inflation, and that is interest rate. So how far can you use interest rate to bring price stability, and what are the effects of interest rate on the economy? Historically, central banks could understand that interest rate hikes could bring economic pain and turbulence in the economy, which would lead to a sharp pullback in the lending and slowing the economy down. Right? So economy slows down due to cash crunch. For example, SVB had a cash crunch when people couldn't found lending very expensive compared to what rates they were getting it for. When the interest rate is hiked, it is to be remembered that the mortgages, auto loans, and credit card borrowing, and even the simple lending process that you see in across the world, the lending mechanism, it becomes expensive. So people tend to spend less, which will give companies a chance to go under, right? Like the economic activity is reducing when the interest rates are hiked. So we believe that interest rate is a trigger point. However, I would like to say that interest rate is a trigger point that just expose the fault lines. For example, the risks taken by the banks and non-banking financial institutions are exposed when the rates are hiked. So what could have banks done? So there were many interest rate hikes that has led to economic catastrophes across the world. We can begin with the savings and loan crisis back in the 80s, the Asian financial crisis, the dot-com bubble. All of this happened after subsequent rate hikes. And we can also understand that previously the rate hikes happened and the drama and the bubble in the US housing system was exposed by the rate hike with the global financial crisis of 2008 and 2007 and 8. So now the question comes, how similar is this banking crisis, which my colleagues were able to explicitly describe in a beautiful manner? What has exactly happened? There was a crash crunch, and there were people worrying about their deposits. Even if $250,000 is secured by the FDIC, we see people worrying about their deposits in the US banking system, and the regulators and the government promising that, look, your deposits are safe. So, how exactly is this system different from the 2007 to 8 crisis? First, I would like to begin by making you understand how the banks are during this time, right? Like before 2008, more or less, the banks were highly undercapitalized by today's standards. There were fewer liquid assets and more credit risk exposure. So, since there was a credit risk and balance sheet crisis in 2007 and 8, where the housing mortgages were made into mortgage-backed securities, and there were lesser chance for these subprime mortgages to be paid back into the banking system. This was the problem that led to the collapse of the US banking system then. But now we are in more of a regulatory turmoil. So, this recent turmoil is different in the sense that the banking system has much more funding, much more capital, and much more ability to weather adverse shocks, right? However, it was not basically ready to see the interest rate hikes in a fast and growing manner. It was not ready to absorb the shocks that was generated due to a 10 point increase in interest rate. So the banking turmoil and the lack of proper regulation among US banks, which was restricted to USD $250,000, and the entire cash crunch which was created in the tech sector also was exposed during this subsequent hike in the rate. So we also learned that troubles at smaller institutions can shake the broader financial market confidence. An institution which is the 16th largest bank in US, that is the Silicon Valley Bank, was able to shake the entire investor confidence in US, right? So we see that, for example, in the sense that the turmoil in 1980s, which I talked about before, the Continental Illinois National Bank and Trust and Co., this was the largest bank failure in US history. And this is similar to the ones which is caused by a high inflation and the loss of bank assets. So how less capitalized institutions lead to such an unstable cost can less capitalized institutions can have such a huge impact on even on bigger institutions. So we see about Alina, who has explained beautifully about how bonds of how tier one bonds of Credit Suisse was not able to be managed, and how this led to a crisis, a long-standing crisis in a management of Credit Suisse. So, is it just the interest rate, or is it all calling for a better surveillance, supervision, management, and regulation of the entire banking system? Is this asking us to make better regulations compared to Dodd-Frank regulations, which were brought in during the 2008 crisis? So there are gaps in surveillance and supervision which needs to be addressed at the moment. So resolution regimes and insurance deposits. So we have insurance deposits which are being put in place, right? Like deposits on insurance by FDIC. So in a country like US, we have deposits insured by the FDIC and the Reserve Bank for up to 250,000 US dollars. But in a country like India, your fixed deposits are guaranteed only up to 5 lakhs. So what is the question here? So are we asked? So I really like the question that Alina imposed on us. Are the banks too big for the regulators to even support during a crisis? So can the central bank really act as a lender of last resort in this case, is a question that remains strong and is yet to be addressed in our future discussions. So central banks, in acute crisis management situations, central banks may need to expand funding support to banks, but not only banks, to non-banking financial intermediaries who will be able to extend the shock to banks as well. These tools would help banks do their main function. The function of this central bank is nothing but to maintain financial stability and ensure monetary policy has achieved price stability. So now US has agreed to consequent rate hikes, but is the rate hike leading to price stability, or leading to something bigger than that, which is it really able to address the cost push inflation, or is it able to address or create turbulences in the economy? So that is a real question. Now, what is a greater economic outlook? So, as my mentor, Mr. Sundara Paripurnan, mentioned, banks are a fair weather friend. So, how does it impact the economy in whole? So, a growth at risk metric at IMF, through research, they found that there is 1 in 20 or a 5% chance that the global output would contract by 1.3% next year. There is an equal probability that the gross domestic product would shrink 2.8% in a severe tightening of financial conditions, which will corporate and sovereign spreads widen, stock prices fall, and currencies weaken in most emerging economies. So, this is not just the US we are talking about. We have long standing impacts on the trade and finance system. We have long-standing impacts on the currencies in more weak economies. So, with this, I would like to open the floor to the audience. Any questions and answers, my friends? So, thank you so much for everyone who has joined this discussion. I hope you have at least a bit of clarity on what exactly has been going on in the US economy and across the world. So now the floor is open for questions and answers. So can we have some questions from our panelists to the audience, or the audience to the panelists? So just raise your hand so we will give you a chance to answer all your questions. Yes, Arushi, go for it.
So, rather than a question, I want to bring in my opinion for a question raised earlier on by Rishi as to regarding all the banking collapse, all these crises, who is to be sort of put at blame, who is supposed to be sort of the one who would face the brunt. Though it is the common taxpayers, though it is the common people who end up facing the brunt, but in my opinion, from the limited research that I have done and from the different articles that can be seen, I feel that it is the bigger body, the Federal Reserve of the United States, that could be placed a bit higher in the hierarchy of placing a blame if need be, because it was their from all the discussion we found out that it was their job, it was their requirement to ensure that all the banks are following the policies properly. They are able to sort of conduct correct checks and also put the wrong policies into scrutiny and correct them, which were not done in a timely manner, which lead to the collapse of certain regional banks. And also, we can see similar trends across the globe. So the federal bank, who has the power, who has the authority, should be put at a stature of responsibility. Of course, the banks have a game to play. They have their own private outlook towards these things, but I feel that it is the federal banks and central banks that has to take the responsibility for this. I'm free to definitely get second by anyone else with different opinion.
So I would really like to add on to what Arushi said. It is the federal bank that has led to the that has ultimately taken the decision of a rate hike and other things. So it is the role of the central bank to ensure price stability. But it is due to a larger financial outcome that they are taking this decision, right? Like, it's not just that one day they decide, okay, I have to hike the rates in the market. So it is a solution to a potentially bigger problem. So I would like to impose this question to the panelists and the audience, that is it just the rate hike, or is it something bigger that we're forgetting to address here? So even if it's not addressed, it is something that we could take back from this discussion. Right. So a rate hike is just a solution to a potentially bigger problem. It is obviously a problem, and it is something that we must blame the federal bank for. Yes, Jerome Powell's speeches are scary these days. It is something that we all eagerly wait for to see the reaction of the market. Now I open the mic to Alina for further discussion.
Hi, I totally agree with your points, but I also would like to say that what you said is a proper measure at an escalated level. Many of the things could have been controlled or prevented at the grassroots level also. So that is within the bank. So before giving out loans or partnering with other investors, they have to go through a thorough check. The risk exposure has to be properly measured. The systemic risk has to be analyzed properly, and preventive measures have to be taken. And if there are the topic that I discussed, I was talking about Credit Suisse. There were so many scandals, and they had enough profits to cover it up. But why would that be the case? Be they should have actually tried to avoid it in the first place. So all these issues at the time of crisis got exposed. The vulnerable, the weak links were exposed. So if things were right at the grassroots level, I think many of the issues could have been avoided in the first place.
Absolutely, Alina. So that's where it all starts. So a regular management or a supervision of the processes, the daily activities, if it had been supervised, meant most of the crisis could be avoided. In the case of SVB, we see that they are funding the tech startups, but how sustainable are tech startups at a full level? So they have reached the peak of development, and every business activity will have a peak and a sharp trend. So was non-diversification of their services also a cause of the crash, is something that I would like to ask Rishi also at this stage, because SVB simply serviced tech startups. So this is something that I would like to understand from the panelists here. So how much does it affect?
Uh, well, it depends. I mean, obviously, technology is one thing, but then if you look at the market and the graph, overall, the markets also move in a very large, not like 1 or 2 years, but if you look at a graph of maybe 50 to 100 years, the market also moves in a certain pattern. I'm forgetting, I did see something on LinkedIn, a renowned professor who had put in a cycle where there are large cycles of 15 to 20 years, and there are cycles in between that of 5 to 10 years where you can see a growth in the market, and this is regardless of the industry. It is a growth in the market where you would see a uptrend in all sort of industries, and then there is a downtrend which basically leads to a downtrend in the industries, will lead to a sort of interest rate hikes and all sorts of measures coming in from the Fed and globally. I mean, even EU and BOE and other the larger central banks. So that's what I would like to say.
Yeah, so thank you so much, Rishi, for addressing that the super cycles, and is this just simply a small correction in the market when we come about asset classes as well? So thank you, Rishi, for your answer. And if there are any more questions to be addressed, we would like to take that. Anything from the audience at all, we would be happy to answer.
Hi.
Hi,
I'm,
could
Thank you so much
could
for
you
Mr.
tell me your
Sundaram to.
name?
Yeah, I am Durai. Thank you for the opportunity given by Mr. Sundaram to join this wonderful team. And this is the first time I'm joining the team. And I joined very later, a little later. I'm very sorry for that. If someone is can summarize about this meeting, so it will be much helpful to know more about this meeting.
So we'll give you a quick summary of what has happened here. So the keynote address was given by Mr. Sundar, where he spoke about how banks could potentially do better in a system where through his business experiences as well. After that, it was addressed by Arushi, who explained the root cause, which was COVID, the rate hikes, which was the Russia Ukraine war, and other geopolitical consequences. Then we had Rishi, who explained the beginning of the crisis in the US when the SVB collapsed and what are the potential causes of the collapse. Then we had Lita, who explained how work culture could have impacted this entire scenario, and we had Ritika who explained the crash of the local banks as a due to the crash of the SVP. Then we had other people explain about the global scenario. We had Alina and the back office officer, that is Aruna, and we unfortunately couldn't connect with Omo, who was prepared to explain about the crisis in Nigeria. So we had an understanding of how this created a ripple effect across the globe. Then after that, we had Nivya explain to us about the debt ceiling, and I myself, I have explained about how what were the potential trigger point. Was it just the interest rate high, or there were other contributing factors to this? So this is how we had structured the entire discussion, and we really thank you for joining the discussion and being an
Thank you
active
so much.
participant.
Thank you
Anything
so much.
else?
Thank you so
Thank you so much, and we hope that you could be a part of our further discussion. So question and answer, is that it? It's so boring to end with the question and answer. So we have Nivya impose a question to the panel.
I have a question for Rishi. Since he covered about the collapse of SVB, I think he will be able to answer my question. I believe for the collapse of SVB, from regulatory stand, there is like they are also vigilant, not so uh, vigilant enough to go with their rules. So that might be also one of the major reason the collapse happened. So is there any improvement from the regulatory point of view, since there are like lot of banks which collapse in the recent time?
Uh, Thank you. Thanks for the question, Navi. I think I can probably connect this to the Frank Dodd Act. So I think this has been mentioned a couple of times during our discussion today, but let me just run this over really quickly. As per this act, any banks with assets worth more than $250 billion were required to provide their resolution plan to the Fed. Resolution plan is basically when the bank goes bust, what is their contingency plan? Now, as of right now, the limit is 250 billion. Uh, but earlier, this limit was 50 billion, and this threshold was increased to 250 billion by the Congress in 2018, which was during the uh, when Trump was acting president. So that was, I think, one of the decisions that did not work in favor of the smaller banks. And I believe currently there is some sort of a drama around this act again, where they're planning to uh, bring the limit back to 50 billion. So I think that is something that could uh, help out in such a situation from a regulatory perspective, I would say.
Thank you, Rishi, for taking that, and I'm assuming that we are coming to an end of the Q&A session.